Everyone's debating the same two scenarios right now: crash or melt up, bear market or bull run. Clean, simple, and completely wrong. Because the scenario that actually destroys most portfolios isn't either of those. It's the one nobody's positioning for. I'm Jimmy, and this is Finance Misfires. Today, we're laying out 3 scenarios for where markets go from here, because 2 of them are obvious, and one of them is the one that will quietly wreck you if you're not ready for it. Let's start with the bad news. Whether you believe AI is going to fundamentally reshape the global economy, or you think it's the most overhyped technology since the Apple Vision Pro, one thing is hard to argue with. The numbers are stretched. Badly. Nvidia was trading around 40 times earnings. Palantir sitting around 230 times earnings. Datadog trading at over 420 times earnings. At those multiples, you're not investing on fundamentals anymore. You're essentially pre-ordering hope and paying a premium for the privilege. And the thing about momentum, this stretched, it can stay irrational longer than any short seller can stay solvent. Anyone who shorted Nvidia in early 2025 aged about a decade in 12 months. And the problem extends well beyond the individual AI names because these stocks are pulling the entire market up with them. When Nvidia climbs, it drags semiconductors. Semiconductors drag the broader tech sector. Tech drags the S&P. And suddenly, the S&P 500 is trading at nearly 30 times earnings, almost double its long-term historical average of around 16. If those multiples normalize back toward historical averages, it's not just AI stocks that take the hit. It's everything. But stretched valuations are only half the problem, because the index itself has a structural issue that makes the valuation problem significantly worse. Here's something that doesn't get enough airtime in the mainstream financial conversation. The S&P 500 is supposed to represent broad diversification across 500 companies spanning multiple industries. That's literally the entire pitch. Spread your risk. Own a piece of the whole American economy. Except that's not really what you're buying anymore. Through the first 3 quarters of 2025, the Magnificent Seven, Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia accounted for over 41% of the S&P's total returns. Swap Tesla out for Broadcom, and that number jumps past 55%. And collectively, these 7 companies represent over 35% of the entire index's total market cap. So, the index, that's supposed to give you diversification, has quietly become a concentrated bet on a handful of tech stocks. It's like a group project where 2 people do all the work except in this version. When those 2 people have a bad day, everyone's grade tanks. And here's what makes it worse. The explosion in passive investing is pouring fuel directly on this fire. Most index funds and ETFs are market cap weighted, meaning the bigger the company, the more weight it carries in the index. So, as these tech giants grow larger, they automatically consume a larger share of every dollar flowing into passive funds. New money comes in. It gets disproportionately allocated to the same handful of names. Those names get bigger. They pull in more new money. It's a feedback loop that works beautifully on the way up, and it becomes genuinely dangerous on the way down. A 10% pullback in Nvidia doesn't stay in Nvidia. It bleeds into the Nasdaq, into the S&P, and suddenly a portfolio you thought was diversified is reacting to the mood swings of 7 companies. This one isn't a prediction, it's just math. Since 1954, the S&P 500 has averaged a pullback of at least 10%, roughly once every 3 years. After several consecutive years of outsized returns, the historical pattern says it's time to pump the brakes. Corrections aren't anomalies. They're normal. They're healthy. The market needs them the same way an engine needs maintenance. Skip it long enough, and the breakdown gets a lot more expensive. But, and this is the part that makes the bear case genuinely uncomfortable to act on, being right about valuations doesn't mean being right about timing. As economist John Maynard Keynes put it, markets can remain irrational longer than you can remain solvent. You can be correct on every single data point in the bear case and still get absolutely wrecked if your timing is off. Being right too early is functionally indistinguishable from being wrong, which is why the bear case, as real as it is, doesn't automatically tell you what to do. All right, let's flip to the other side of this trade. Because, for all the legitimate concerns in the bear case, there are real structural tailwinds that bulls are pointing to, and the biggest one is the one that quietly drives everything else in modern markets: interest rates. Whether you trust Jerome Powell's judgment completely or you think the Fed runs monetary policy through a magic 8-ball, the direction of rates is pretty clear. They're coming down. 2025 ended with the Fed delivering 3 consecutive 25 basis point cuts. Going into 2026, the median market expectation is at least one additional cut on top of that. Here's why that matters beyond just mortgage rates and car loans. Lower rates mean cheaper capital. Cheaper capital means higher valuations. Higher valuations mean investors become more comfortable paying a premium for future earnings because the opportunity cost of holding risk assets versus cash or bonds shrinks. Liquidity loosens. Financial conditions ease. Risk-on assets come alive. That's how you get markets grinding higher even when the underlying economic data feels mixed, confusing, or slightly uncomfortable to look at directly. Rate cuts don't just help borrowers. They reprice the entire investment landscape. And right now, that repricing is working in the bull's favor. And monetary policy is only half the story. Because while the Federal Reserve debates quarter-point adjustments, the U.S. government is doing something far more blunt and far more impactful: just spending aggressively, continuously, at scale. The United States is currently running $1 trillion-plus annual deficit. And before the fiscal hawks in the comments come for me, yes, this is a serious long-term structural problem. I've covered it on this channel, and I'll cover it again. But in the short term, government deficit spending puts money directly into the economic system. It supports consumer demand. It props up corporate revenues. It keeps economic activity elevated even when private sector momentum starts to cool. And here's the key thing about fiscal policy that makes it different from monetary policy. It's slow to change. Programs don't get shut down overnight. Budgets don't get suddenly slashed. Politicians don't win re-election campaigns by running on spending cuts and austerity. So even if economic growth cools heading into late 2026, the fiscal backdrop stays supportive longer than most bears are accounting for. That's a real tailwind, and it's one that gets consistently underweighted in the doom and gloom analysis. Put rate cuts and deficit spending together, and you've got a macro environment that can keep markets propped up longer than the valuations alone would suggest they deserve to be. Here's where I'm going to say something that neither the bulls nor the bears are going to love. The most likely outcome for 2026 isn't a melt-up. It isn't a crash. It's something significantly harder to navigate than either of those clean narratives, and it's the scenario almost nobody is actually positioned for. Soft landing, hard landing, no landing, all still somehow on the menu simultaneously. And that confusion, that's not a temporary state waiting to resolve. That's the market environment itself. A long, grinding, choppy, sideways market. Not the exciting kind of volatility where you get a dramatic crash followed by a sharp recovery and a clear opportunity to buy the dip. The frustrating kind, where headlines flip every 2 weeks, where rallies stall just as confidence starts building, where dips feel scary without ever becoming deep enough to offer real entry points, where every decision feels slightly wrong and capital just rotates endlessly between asset classes without going anywhere meaningful. Panic selling on a red week, chasing momentum on a green one, switching strategies every 30 days because nothing seems to be working. This is the gray area that sits between the bull and bear case. And it's the market environment that destroys the most portfolios, not through one dramatic wipeout, but through a slow accumulation of impatient decisions made by people who couldn't tolerate the uncertainty. Here's the psychological trap that sideways markets set. When markets crash, it's painful, but the signal is clear. You know something is wrong. You can respond. When markets rip higher, it's easy. You're making money. Confidence is high. But when markets grind sideways for months, that's when the noise gets loudest. That's when the dumbest decisions get made. The investors who survive these environments aren't the ones with the best predictions. They're the ones with the most discipline. The ones who absorb information, build a framework, and don't let short-term market noise override long-term thinking. And honestly, that's a systems thinking problem more than it is a financial one, which is exactly why we cover it here. Let me be straight with you about something before we wrap this up. Nobody, and I mean absolutely nobody, actually knows what the is going to happen in 2026. Not the hedge fund managers, not the macro strategists, not the guys with the loudest takes on financial Twitter, not me. Anyone telling you they've got the year figured out is either lying, trying to sell you something, or both. Usually both. What I do know is this. The bear case is real stretched valuations, dangerous concentration, and a market statistically overdue for a reset. The bull case is also real rate cuts, government spending, and a macro backdrop that can keep things propped up longer than fundamentals alone would justify. And the gray area in the middle, the choppy, sideways, patience-destroying market, is the scenario that the fewest people are actually prepared to navigate. The best thing you can do right now is absorb as much quality information as possible and come to your own conclusions, not someone else's conclusions handed to you with a confident tone and a thumbnail. Yours. This is exactly what Finance Misfires is built to cover, not predictions, not hot takes designed to get clicks. The actual frameworks, the structural analysis, and the money psychology behind how these markets work, so you can think for yourself instead of just reacting to whoever was loudest this week. Drop a comment and tell me where you land. Bull, bear, or grinding sideways hell? I want to know which scenario you're positioning for, because the split in this community is always more interesting than anything the mainstream consensus produces. Subscribe, drop a like, and share this with someone who's been making portfolio decisions based on vibes and financial news headlines alone. I'm Jimmy. Stay sharp, stay patient, and I'll see you in the next one.